All right, welcome to the Explainer. Today, we're putting on our detective hats to solve a classic corporate finance mystery. Okay, so let's dive right into this. You've probably seen this happen, right? A company posts these glowing financial reports, everyone thinks they're totally solid, and then, seemingly out of nowhere, they just collapse. How on earth is that even possible? So, to figure this out, we've got to think like financial detectives. The company's books, that's our crime scene. And we're on the hunt for clues hidden in plain sight that are going to tell us the real story. The very first clue, and honestly, the most critical one, is something called liquidity. Think of it like this. Liquidity is the financial lifeblood of a business. It's all about its immediate ability to cover day-to-day costs and, survive any unexpected shocks. Without it, even a profitable company can go under. Okay, so how do you actually measure this financial lifeblood? Well, the go-to tool, the first thing analysts usually pull out, is a metric called the current ratio. It's kind of our first surface-level check on the company's health. And the idea behind it is pretty straightforward. You just take a company's current assets and divide them by its current liabilities. In other words, you're just comparing all the stuff a company expects to turn into cash within a year against all the bills it has to pay in that same year. Simple enough. So what exactly are we talking about when we say current assets? Well, you've got things that are really close to cash, like securities or accounts receivable. That's money your customers owe you. But then you've got inventory. And I want you to pay close attention to that one, because as we're about to see, not all these assets are created equal. Now, generally, a current ratio of 2.0 is seen as the gold standard. It suggests the company has $2 of short-term assets for every $1 of short-term bills. Looks great, right? But here's the thing. That number can be a total illusion, hiding a really critical flaw. And that right there brings us to the heart of our whole investigation, the inventory illusion. Let's peel back the layers and see how this one asset can completely mislead us about how stable a company really is. So who's the bad guy in this story? Yep, it's inventory. The problem almost always comes down to inventory. And why is that? Because when you're in a pinch and you need cash fast, inventory is often the absolute least reliable thing you can count on. I mean, think about it. Relying on inventory to pay your bills is just so risky. Market demand can disappear. New technology can make your entire stock worthless overnight. If you need to sell it fast, you're probably going to have to slash prices. And maybe the biggest thing, it just takes time to turn stuff into actual cash, time a company in crisis just doesn't have. Okay, so if the current ratio is so easily fooled by inventory, what do we do? There's got to be a better way, right? Well, there is. Let's bring in a much tougher, more rigorous tool that just cuts right through all that noise. It's called the quick ratio, or my personal favorite, the acid test ratio. I mean, what a great name, right? It was designed specifically to solve this inventory problem by giving us a much more immediate and much more realistic look at a company's ability to pay its bills. So how does it work? Well, just look at the formula. Notice what's missing? Inventory. It's gone. It only includes the most liquid assets, cash, securities, accounts receivable, and divides those by the liabilities. It intentionally kicks inventory to the curb to give us a much more honest picture. And when you put them side by side like this, the difference is just night and day. The current ratio gives you that broad overview, but it can be really misleading. The quick ratio, on the other hand, well, it's called the acid test for a reason. It shows you the cold, hard cash reality of the situation. All right, let's circle back to our mystery company. Remember that healthy current ratio of 2.0? On the surface, everything looked fantastic. But then we run the acid test, and what do we get? A quick ratio of 0.7. Wow, that is dangerously low. It means without selling a single thing from its inventory, it only has 70 cents for every dollar of bills it owes right now. All of a sudden, the picture changes completely. This company is in big trouble. And just like that, mystery solved. And this, right here, shows you the real power of good financial analysis. It's never about just one number. The real test, the real magic, happens when you compare them and see the story they're telling together. So here's the big takeaway, the thing you absolutely need to remember. The wider that gap between the current and quick ratios, the more a company is basically betting its survival on being able to sell its inventory. A big gap is a massive red flag. Now, it's super important to remember that this whole story changes depending on the industry. You'd expect a car dealership to have a huge gap, right? Their whole business is big, expensive inventory. But a software company? almost no gap at all. A grocery store might have a low quick ratio, but its inventory sells incredibly fast. So yeah, context is absolutely everything here.
So, to wrap this all up, what's the bottom line? The current ratio is just a first glance. The quick ratio is the real test of a company's ability to survive. But most importantly, that gap between the two, that's where the real story is. It tells you exactly how much a company is leaning on its inventory sales. You always have to use these tools together to get the full picture.
And that leaves us with one final pretty big question to think about. We always hear cash is king, but if that's really true, then what exactly is all that inventory sitting on a company's books? Is it a valuable asset just waiting to be sold? Or is it a potential liability, a ticking time bomb of risk?